the way to get an edge is to go to the absolute opposite end of the spectrum and try to be more patient than almost anybody else out there. That, of course, is very difficult to do, especially when people are focused on the next quarter or the next month or the next week or the next trading day in a lot of cases.
We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Matt Geiger, Managing Partner of MJG Capital. Thanks for joining me today, Matt.
Hey, Tom. Good to be back on the program. Thanks for having me.
Great to have you back. And, I'm looking forward to having a chat about kind of the year ahead that we have to look forward to here. In reading your 2021 kind of year in review, it really struck me that 2020 was a real banner year for you, while 2021, as you put it, was a relatively dull year and only saw about a 4.6% gain. So while this seems dull, over that same time period, the GDX and GDXJ were both down for that same time period. So what do you attribute that success to over the GDX and GDXJ?
Yeah. So, I think dull is a good way to describe the fund's performance in 2021. We were up 4.5% or so net of fees and expenses. That said, as you mentioned, this came off of a year in 2020 where we were up 115% net of fees and expenses. So far and away, the fund's best individual year since inception. Looking back on 2020, just think of where we were in the depths of March and April of 2020 after the COVID panic. To think that we would have gone from a 30 to 40% drawdown to up more than double in the year kind of exemplifies the roller coaster that this industry can sometimes be. So 2021, a little bit boring. I'm perfectly fine with that, to be honest. I thought there'd be some level of consolidation after the strong year of 2020. And the fact that we were up, albeit marginally, is positive. That's the fund's third consecutive year of positive performance. And we've now been up 5 of the past 6 years, which I'm quite proud of. Maybe not too much of a surprise to your listeners, knowing that kind of the broader metals cycle started to transition in 2016. But really our only down year since then was 2018, if I'm not mistaken. To your point about outperformance of the GDX and GDXJ, I'd like to claim that comes down purely to security selection, but that is not the case. I think the reality is that the fact that we weren't all in on gold and silver helped returns quite a bit. I have quite a few fund manager friends who I respect very much. Really, regardless of security selection, we're down across the board. It's been a really painful 18 months, really since August of 2020. If you're in the precious metal space. And so, yes, we did lose some ground with some of our precious metal focused names, but the portfolio was carried by a large part by our energy metal focused names and some ag mineral exposure as well. As we stand, we're about a third of the weighted portfolio is in either gold or silver at the moment. And I'm feeling pretty comfortable with that weighting. You may remember, although back in August 2020, it got as high as 75% of the weighted portfolio was focused on gold or silver. I made the decision then to refrain from any new precious metal focused positions and to take profits in some of our names and liquidate other names. So we're now back to more what I view as more of a reasonable weighting in this market environment.
So Matt, as you mentioned there, you had a 75% weighting to the precious metals in August of 2020, and it's down, like you said, roughly to about 35%. Was that an active choice on your part, or is that kind of more of an artifact of the shrinking position size of the metals?
Yeah, good question. It's a little bit of both. I very much look at investing from a bottom-up perspective. And so when I'm evaluating a given company, I truly do try to put the target metal out of my mind until the very end of the process. Focus in on the people, focus in on the asset at spot metal prices, whether that metal zinc, uranium, gold, it doesn't matter. Focus on the company's financial structure, their upcoming catalysts, their price to value, the jurisdiction. Only then do I really consider the metal of focus. So very rarely will I make decisions, portfolio allocation decisions based off of a specific metal. That said, this was an exceptional circumstance. I mean, we saw gold and silver just go on an absolute tear for 6 months through the end of through August, September of 2020, and it just got to the point where I said, this is too much within our broader portfolio. We're a hard asset, we're a natural resource investment fund. We're not a gold and silver focused investment fund, and so it got to an extreme point where yes, I made the active decision not to add any new precious metal focused positions, and also not hesitate to trim some of our winners, and in a couple cases, liquidate positions that I think the moves had been overdone. So that active decision making, combined with what has been close to 18 months now of battery metal, green metal, energy metal, however you want to describe it, outperformance relative to precious metals, has kind of led us to the position that we're in now. I should also mention that inflows also will help get the overall percentage down. Inflows into the fund, as long as you don't take that and deploy into gold and silver. That said, we have added a couple precious metal focused positions here just within the past few months. So that decision to kind of steer clear, that is in the past. I'm probably in this environment more excited about precious metal focused names, to be honest, than the energy or battery metal names, just given the crowds and the speculative excitement that we're seeing around that.
Mm-hmm. When we're thinking about, let's say, your week to week or your month to month trades in the portfolio, you're not necessarily really, trading this stuff every day. This is more so an evaluation of a strong company and a strong thesis on your part, and then just watching what it does from there, right?
That's very much the case. Yeah. I mean, last year, for some context, we only added four new positions to the portfolio over the course of the entire year. So that's one new name, coming in every 3 months. I will say that was a particularly inactive year, you could say, so to speak. But that's the general sentiment. And I'm not relying on TA heavily here. I'm not trading in and out of names. I think that, especially over my life here, and it's probably only going to continue, the time frame of investors has just gotten shorter and shorter and shorter and shorter. And that also has a lot to do with the advent of machine trading and quantitative trading and all these really short-term oriented strategies. Mm-hmm. I think unless you're going to compete with the machines, and that's very difficult unless you're designing your own, the way to get an edge is to go to the absolute opposite end of the spectrum and try to be more patient than almost anybody else out there. That, of course, is very difficult to do, especially when people are focused on the next quarter or the next month or the next week or the next trading day in a lot of cases. But I think, at least for my temperament and my investment philosophy, I'd rather err on the other side out of the spectrum and be able to outweigh people. That's also explains my emphasis on people, though, as well. I think the longer that you're holding a given position, the more reliant you are on the people and investors, in charge of that company to be making decisions that are both prudent and also in your best interest. So, I think you can get away with trading a good asset with mediocre management and, make money over shorter time frames. But if you're going to try to hold something for 3, 4, 5 years, you want to make sure that you're fully on board and you fully trust the folks that are calling the shots. Mm-hmm.
Yeah, that speaks to more towards the fundamentals of the company and the management, right?
That's right. Yeah.
So while you were mentioning that the energy metals and the ag mineral focused investments offset the precious metals weakness, is there any reason for you right now to be thinking about, trimming some of those positions because of the gains, or any of the macro factors for the energy metals or ag mineral focused investments back at this point?
I would draw a distinction between the two. So let's start with the energy metals, or the green metals, so to speak. Firstly, I'll say I'm very excited about this niche of the market, but we're talking about 4, 5, 7, 10 years down the line. I think it's going to be an excellent decade for these metals. And, whether you're for it or against it, the reality is that we are seeing a global decarbonization push. And these metals are just going to be in demand. There's no ifs, ands, or buts about it. So again, over longer term time periods, this is a great place to be. The issue in the current market environment is that's not a secret, right? There's a lot of punters, there's a lot of retail investors, there's a lot of generalists that have kind of glommed onto this narrative, so to speak, in the past 18 months. They're getting excited. They're rushing into the lithium names. They're rushing into the uranium names. There's excitement about copper or what have you. So for this niche of the market, I think as long as the music keeps playing, as long as the broader markets hang in there, either tread water or continue to rise at the meteoric rate we've seen over the past 18 months, like this is going to be a great place to be. That said, when there's that next big risk off event, watch out below, especially for lithium, especially for uranium. Like the amount of buzz that I see on social media and in newsletters, and there's just a lot going on. It doesn't mean that these aren't good places to be over 4, 5, 7 year time horizons. But two things can be true. It could be a good bet over the next 5 years, and you could still be down 30, 40, 50% 6 months from now. Both of those things can be true. So I would absolutely caution investors, especially if they haven't been in the mining industry before. They're getting excited about these narratives. The narrative can be true, and you can still lose a lot of money, at least on paper, in the short term, especially when a trade is crowded, and especially when the market goes into a risk-off event. I mean, heck, when the broader market goes into a risk-off event, all juniors get smacked. Even the precious metal-focused names. That said, sentiment's pretty negative right now for gold or silver, so I would think that downside would be more muted if we went into a March 2020 like sell-off starting tomorrow, relative to the energy metal names. Ag names, or in terms of the ag minerals, the inputs into inorganic fertilizer, that's an interesting case, because I think that's also going to be a very lucrative place to be over the coming years. I mean, it's been a good 15 years, really since 2006, 2007, since we've had a proper ag mineral cycle. Obviously, these materials are incredibly important for our 21st century way of life. Without inorganic fertilizer, we would have large amounts of people starving. It's as simple as that. We don't have to use inorganic fertilizer, but we've become dependent on it in a way that it's going to be very difficult to reverse the trend there. I think a lot of smart folks are realizing that this is a place to be. There aren't too many juniors, especially if you look at phosphate focused names. There's maybe a dozen. Potash, there's a few more, but this compares to hundreds of lithium companies, hundreds of uranium companies. You're just not seeing the same speculative buzz yet. So I think this is slightly more contrarian of a place to be than the battery metals. That said, as mentioned, when you go into risk off, all juniors get hit in the immediate aftermath. The baby gets thrown out with the bathwater, so to speak. So I think you need to be cautious here as well, even if it is a good outlook in the medium to long term.
So Matt, when we're thinking about that risk off event that affects the commodity complex as a whole as well, do you think that gold and silver are likely the first things to rebound, or do you put any strategy thought towards what rebounds first?
Yeah, to some degree, but I try not to. I think it's important to have a macro framework and have a sense of where things are going. That said, I don't base decisions off of that, so to speak. Maybe I do on the margins in terms of timing. I really like an investment, but instead of entering into it now or doubling in on it now, I do that in a couple of weeks. So I think it's important to have a macro framework, but not let it dictate your decision making, so to speak. I also think it's helpful to have a macro framework psychologically. So if things go in a direction where you're not expecting, or you can act more rationally, and not act from emotions, which can be tempting, especially in a very volatile niche of the market, like mining and junior mining in particular. To your question. Recent history suggests that yes, gold and silver will move first. There's a couple examples. I mean, first, just going back to March and April 2020, in terms of the overall commodity complex, gold and silver just rocketed off of the bottom there, and it took a good 6, 7, 8 months for these other metals, these other materials, to start gaining some traction, and it took like a year and a half for people to start getting excited about oil, gas, and coal again, like we see in the current environment. So I think history will likely repeat. There's no immutable law of nature that says it has to work out this way. But we saw that in the very recent past. And then taking it back a step further to late 2015, Jordan Roy Burns has been talking about this. I know he's a frequent guest on your program. Last time that we saw the first rate hike after what had been a easing cycle, we did see a final capitulation sell-off in the weeks before. It was kind of a sell the rumor, but then buy the news type event, where, upon the day of the rate hike and in the weeks after, that's when we saw, the first major precious metals move in what had been 4 or 5 years. The rally from late 15, early 16 through late 2016 was one for the ages. And that was probably, I think 2016 was their second best year of performance since inception. So recent history tells us that if there is a big sell-off event, which probably would coincide with a rate hike or two, gold and silver move first. And then additionally, when you do have that first rate hike, you'll generally see the precious metals move, particularly if the market then starts to price in the fact that these rate hikes aren't sustainable and that they may be paused, which I think is what we're going to see here. So there's kind of these two different anecdotes overlaid on top of each other. History suggests that, they'll move first. The big question on my mind is whether we have that final capitulation sell-off beforehand, or whether folks are front running this, understanding that in recent history, rate hike has been good news, kind of paradoxically, for the precious metals, and whether it doesn't quite repeat this time. But my sense is that final leg lower, everybody brace yourself for that. And then upon the first rate hike, I think this, 18, 19, 20 months of pain we've seen in precious metals reverses.
Mm-hmm. So one chart that you included in the letter this year is the percentage of S&P 500 members with a price to sales ratio greater than 10. And it just looks like a parabola. It's shocking. So does this really speak to the riskiness of this time in the S&P and how companies are being valued by speculators?
It does. Yeah, that was a pretty disturbing chart, if I can call it that. We'll say, and I mentioned this in the intro of the investor letter, which is available on the MJG website if folks want to check it out. It's a real conundrum to be a natural resource or mining focused investor at the current moment. On the plus side, these hard assets, really across multiple metrics, are cheaper relative to other financial classes, specifically the broader stock market, than they've been in 30, 50, 100 years, depending on the metrics that you're looking at. Mm-hmm. But they all tell the same story, whether you look at physical commodity prices, the GSCI relative to the S&P, whether you look at the natural resource industry as a whole, including oil and gas relative to the broader stock market, whether you look at mining companies specifically, ex oil and gas, it's all telling us the same story from a relative perspective. This asset class is very cheap, both to equities and many other asset classes, which are also trading at all-time highs. Bond markets, one example. Real estate is another. Cryptocurrency is its own thing as well. That said, and to your point here, the concern is that the broader stock market itself is dangerously overvalued, in my opinion. And I look at two things there. First is the actual valuations, and then the second is sentiment. And I think both of these are lining up to, create a pretty significant concern. Again, there's many different metrics you can look at. That one that you referenced, though, really stood out to me. We're literally, there's twice the amount of companies in the S&P 500 trading at 10x plus revenue, price to revenue numbers than there were in the very peak of the dot-com bust, back in 2000. So that tells you right there, okay, on the valuation side of things, we're stretched. But where are we sentiment-wise? Well, sentiment-wise, last year, and this is just a jaw-dropping anecdote, it comes from Bank of America from just a few weeks ago. They put out this data point. Last year, they estimate that retail investors put more money into the stock market, as measured by the S&P 500, than the previous 19 years combined. Wow. So we have high valuations, overlaid with euphoric investor sentiment. And that's what causes me pause. That's what causes me concern. Because even though I know that my investments are cheap relative to this asset class, I think we're ripe for a correction broader. And through experience, I know that those can be painful incidences, especially if you're focused on kind of risk on equities like the junior mining space is. So that's why I've kind of gone into much more of a conservative, capital preservation mindset within reason. Mm-hmm. And I've done that by raising the cash position within the MJG fund. Really, since inception, we've almost been fully deployed the entire time. But since early last year, I've been inching up our cash position, so we're now north of 15%. If we don't see that big, sell-off in the next 6 months coinciding with rate increases, then I'd imagine we'd be closer to 20% cash in by mid-year. That can be difficult. It takes discipline. But I take comfort in the fact that one of the best investors of all time, Warren Buffett, is sitting at 32% cash. So if folks are out there and they're sitting on some cash and they're getting antsy, just remember that there are smart folks out there that are preserving that dry powder for the next fall. And like dry powder, there's 3 benefits when you go into a market crash. The first is that it mutes the downside to some degree. The second is that it helps you keep your head. So you don't react emotionally. And the third is that it provides dry powder to deploy into the carnage. So it's difficult to time markets. I'm not trying to get it perfectly right. I like the Carveth Reed saying it's better to be approximately right than 100% wrong. And so, I'm not making a hero call going all in or all out of the portfolio, but just getting progressively a little bit more conservative with the anticipation that these next 18 months are not going to be like the past 18 months. I feel pretty strongly about that.
Mm-hmm. Yeah. One thing that struck me as you're kind of sharing that anecdote with us about there being more cash deployed last year than all of the past 19 years combined, it makes me wonder what the amount of leverage that was also deployed. And when you mentioned the emotion piece, when you see a fall, how that emotion and the leverage will really play into how spectacular of a crash we could see. I mean, I believe it was yesterday, Facebook missed their earnings and they were down something like 23% overnight with the market being closed. And they're still down this morning when I look, just out of interest. So it really makes me, wonder how spectacular we could see something like that unravel, right?
I think that's right. And another kind of adding on to that point, another trend that has worked to the market's benefit, really since the great financial crisis, we'll say over the past 15 or 20 years, is the rise of passive investing and in these ETFs. And it's created this positive, a self-perpetuating flywheel, where stocks go up, people see stocks, they buy the ETF then invests in the stocks go up further. And this has worked to investors' benefit here, at least if you're long the stock market for the past 14 or 15 years. But this cuts both ways. It is a double-edged sword. And we haven't seen a true risk-off event absent, the short panic sell-off in March 2020 that was arrested by, extraordinary actions from both governments and central banks. Mm-hmm. But that next true bear market, like this is going to come back and bite investors. And ironically, companies that are not within ETFs are probably going to have an advantage over that period, which is kind of the inverse of what we've seen. If you could get into the major ETFs, I mean, even within the precious metal space, getting into the GDXJ, getting into the GDX, you see massive inflows of capital. It's a big deal, but of course, when the market's cutting against you, it works the opposite direction. So I think we could see the scenario where it's a virtue for a company not to be included in one of the major ETFs if we're in this scenario.
Yeah, that's an interesting point. So Matt, when we take all those things into consideration, how do you think these coming 5 to 10 years differ from the past 14 years post the great financial crisis? Do you see these trends obviously reversing? But how do you think these next, say, 5 to 10 years really differ from that?
Yeah. Well, I would argue there's been 3 major trends that we've seen over the past 14, 15 years since the great financial crisis. One of them I just mentioned, which was the outperformance of passive over active investing in this, euphoric, very strong market environment. Not going to put an exact date, but I think over the next 5 to 10 years, like you say, this trend is going to reverse. And I think it's a good time to be actively managing money, or have your money in the hands of a competent active manager who's doing true security selection and try to buy something for below what its reasonable value is. Not worrying about flows, not worrying about what ETF it's in, not worrying about the general narrative or what have you. So I think we see that reverse. Second trend, I think it's pretty inarguable, is that we've seen the US trounce the rest of the world, particularly emerging markets. That's been 14 to 15 years running at this point. To me, that has to reverse. If you look at the global economy as a whole, as a percentage of GDP, the US is 25% of the overall global economy from a GDP perspective. But if you look at the financial markets and the total market capitalization of US-based companies, we're at 55% of the total global financial system. That doesn't make sense. It just on face value, something has to give. I guess one solution is that the US economy grows relative to the rest of the world. And in 10 years, we see the US economic activity comprising 50% of the globe. I think that's exceedingly unlikely. I think it's more likely that the US treads water at its 20% level, and we see the percentage of US of the overall market capitalization drift closer to where the US is. So, I'm not a financial advisor, and as you know, within MJG, we focus very, very specifically on the junior mining space. I will say personally, as some diversification, vast majority of my net worth is in the fund I manage, but I do own some emerging market value equities to take advantage of what I think is going to be a trend over these next 5 to 10 years, which is money flowing out of the US into the rest of the world, specifically, emerging economies. And then the third trend is this focus on growth over value that we've seen over the past 15 years. And I think the reason for that's simple. We've seen progressively lower interest rates. I mean, that's more of a 30, 40-year process, but over the past 10 years, and the lower interest rates are, the more, the less likely you are as an investor to prioritize immediate cash flow. You're able to, if you're using a 0% discount rate, cash that a company's making 10 years from now is the same as cash that they're making next year. So it's easy to have these pie in the sky numbers for what revenues will be in the future, what user numbers will be in the future, what have you. That's why we've seen tech, have an incredible run here over this decade. But I feel firmly that, especially as we move into what's an inflationary environment with likely higher interest rates, or at least the Fed trying to get there, that we're going to see the pendulum swing back towards value. And, this is one of those scenarios where, just like in the late 90s, you look at the Warren Buffetts of the world, they're out of style. People are questioning whether he's lost his touch. Anytime that you see those scenarios, that's usually a sign that we're about to see the pendulum swing back from growth to value. And I think we'll see the same here. So those are the trends: passive over active. I think that's going to reverse. US over rest of world. I think that's going to reverse. Growth over value. I think this is going to be a decade for value investors and not growth.
So Matt, we've talked about companies over a lot of different kind of spaces. Let's say the ag, minerals, as you said, the electric metals, precious metals. How many positions do you like to have in the portfolio? And is this more, let's say, a function of the amount of bandwidth that you have to be able to really pay attention to all of these companies and what they're doing, where they're moving forward, or issues they're facing?
Yeah. So, I mean, our sweet spot is between 15 to 25 names at any given time. So I view that as quite a concentrated portfolio. My goal for each and every one of our investments is to be, the foremost expert, or one of the foremost experts in the world. And I know that maybe sounds grandiose to say, but especially for some of these juniors, there may only be a few hundred people globally they're very, very closely following that, specific junior. And so if you dedicate enough time, you get to know management, you get to know other investors, you get plugged into that information ecosystem. I think it's important to be the foremost expert in each and every one of your holdings. And yeah, like you said, bandwidth. I mean, if you're holding 70 to 80 different names, there's just no way to know intimately what's going on with each and every one of the companies, or to track the expected catalysts or milestones to expect over the coming months and years. So for me, it's challenging. It's a constant battle. It's tempting. I'm not, I will concede to hold more and more names. But I think another benefit of kind of creating a cap almost, and I try to keep 25 as a hard cap, is that it forces you to consider the opportunity costs and look at relative value in addition to absolute value. So if you truly see a name that you have to add to the portfolio, you like the people, good valuation, like the asset, big catalyst coming up, that's fine. But if MJG is at 24 or 25 names already, that will result in me giving the boot to one or a couple holdings in order to find room. And I think that process, while difficult, is healthy from a portfolio management perspective. So again, this is what works for me. I mean, I know some folks that go that much more, even more aggressive, 7, 8 names. Your average junior mining investor, though, from what I can tell, have 50 to 100 names in the portfolio. And I think unless you're have a team of, half a dozen people monitoring 10 to 15 of these investments, that's just far too much for one person to handle. So from my perspective, less is very much more in this space.
Mm-hmm. Yeah, that's an interesting point, Matt. So what characteristics are you looking for when you are initiating new investments within the context of the current market environment? You were saying last year you only initiated 4 new positions. So obviously there must be a real high bar for you to think about initiating a new position.
That's right. Well, one of the key characteristics, especially in this market environment, is quantifiable downside. What I mean by that is you look at the company's current valuation, and what I view as quantifiable downside is the company's liquidation value. So if tomorrow you were given the keys to the company and the investor said, go sell, the positions, pay off the debt, how much are you left over with? For a lot of juniors, the liquidation value is maybe 5% of the overall market cap. It might have a $50 million market cap, and they might have 2.5 million Canadian in the bank. In that case, you can be darn sure in an absolute worst case scenario, full loss of capital or loss of 95% of your capital is on the table. Mm-hmm. That can be fine in some scenarios. The junior gets lucky. It's a great management team. They're working on a good asset. But particularly in this type of market environment, I'm very wary of those situations. I'm more drawn to the deep value opportunities out there. The cigar butts, so to speak, that Ben Graham was so excited about back in the day, and that's also drawn me to the prospect generator niche of the market, which is a business model that's very much out of favor. But you can find companies. One example is Golden Valley Mines. We owned Golden Valley Mines for 4 to 5 years. Over that whole period, it was a true net, which means that the company's market cap was below the value of the cash and marketable securities minus liabilities. Over that whole period, it took patience. It was frustrating, but this was one of our precious metal wins actually in the past years. This kind of stood out in a positive way. They got taken over by Gold Royalty at a very healthy premium, and that investment worked out well, though it took patience. It was rewarding to see that net investing, this classic deep value investing, still works within the junior mining space. I can say at the moment, there's a prospect generator that we've been accumulating. It's one of the names we've precious metal focused names we bought in the past 2 to 3 months. That's trading below the value of its cash and marketable securities. There's other PGs with management teams that I trust, good geologists. Clearly, they're not doing a great job promoting, but their market caps cover 50 or 60% by cash and marketable securities. So I think particularly in this market environment, when you're concerned about that next major drawdown, focusing on juniors where there is some defined amount of downside helps, and again, it's of course it's possible for a company to trade below the value of its cash and marketable securities. We saw that with Golden Valley, for instance, but generally that acts as a pretty good floor. And so, yeah, those are the type of environments, opportunities that are getting me excited in this particular market environment. If 3 months from now we're in a March 2020 like crash scenario, then at that point I'll be focused on quality and some of the names that have absolutely ripped over the past 18 months that I wish I had owned. That's an opportunity to kind of back up the truck there. But for me, I'm focused just as much in this market environment as not losing money as I am in making money.
So Matt, when you mentioned prospect generators and that kind of business model, why has it really been out of favor for near the last 2 decades? And why do you think it has great potential now?
Yeah, well, I could go on about this for quite a while. I did write a piece about it in the investor letter in the market musings section if folks want to check it out. But in short, I would argue that this business model has been out of favor since the 1990s, which was really the last true discovery-driven junior bull market. Those were the days of Bre-X, for instance. Even in the very strong bull cycle between 2001, 2002, and say 2007, 2008. Some people would say all the way to 2011, just depending on how you divvy it up. Even during that period, Chinese-driven commodity super cycle, that was much more of an exercise of revisiting previously existing deposits that had been discovered, drilled out, and then applying new metal prices to them. So that was very much an optionality market. There were some major discoveries, but it wasn't much of a discovery-driven bull market. In addition, the seniors and the major producers over that period burned their fingers very badly by acquiring some of these large marginal assets with the belief or expectation that metal prices were going to keep rising. And they took on debt and strained their balance sheets to do so. As we know in hindsight, starting in 2011, we went into a terrible bear market. And a lot of these companies had to write off the value. You had to raise money to repair, balance sheets, and it was just a very rough period. So I think the major companies have learned their lesson, and the focus here is going to be more brownfield expansion and organic growth within their actual portfolio, and then also going further upstream to find those major new discoveries, even if they're earlier stage, that make a ton of sense at the current metal prices. So, look no further than Mark Bristow, who's, one of the major leaders in this industry as CEO of Barrick Gold. He says in this cycle, value is going to be driven by the drill bit. And I think, take it from his mouth. Don't take it from me. And so that's going to be a good place for these prospect generators. A lot of these major companies haven't been embracing grassroots earlier stage exploration for a number of decades now. And also over the past decade, in a lot of cases, have trimmed or cut entirely their exploration teams. So I think companies with that geological IP and prospective ground that's been accumulated over these prior years are in a really great position. And then the final point I'll add is that we've seen metal prices across the board rise pretty substantially here over the past 18 months. And I have a good chart from S&P Global Insights within the investor letter, but we've yet to see exploration expenditures catch up to these metal price rises. Mm-hmm. That's in a large part due to COVID, and it's hard to get out in the field, or at least it has been. That's obviously changing. I think we're going to see an explosion in exploration spending here. A lot of that driven by the majors, and it's going to be a good place to be. Coupled with the extremely low expectations for prospect generators, that's what gets me excited.
Mm-hmm. So, considering the amount of exploration that there needs to be and needs to have happen, do you think that there's going to be some attractive private placement opportunities in the coming months? And if so, where would you look to find those?
I think for the precious metal focused names, yes, we're starting to see some good deals, particularly for gold and silver focused investments. Just because it has been an 18-month downdraft here, and even the better teams with strong working capital positions are looking to cash up before their next round of work. That said, I'd be very cautious, elsewhere within the commodity complex, lithium or uranium. I think it's going to be, let's pretend the market goes into a risk off situation starting tomorrow. I think it could be 18, 24 months before we start seeing some actual attractive deals amongst, some of these hotter flavor of the month metals, just because there's been so much capital that's gone into them over the past 6 or 9 months here, that a lot of these companies, both good and bad, are well cashed up. And so there's been no reason for them to kind of capitulate and go to market. So I think in the meantime, if you're going to have exposure to those metals, focus on the best companies that are well cashed up, do not have to raise in the immediate term. Yet, if we do go into a large risk off scenario here, sometime in 2023, I think there's going to be some very attractive placements for some of these battery metal focused names. But that's not where I'm looking from a placement perspective at the moment. That's for sure.
Matt, when you're evaluating, let's say, a company that is putting a private placement out to the market, does it ever concern you, or do you look at a deal differently if they have a warrant attached to it, or is it just necessarily the structure of that financing that you really have to take a look at?
Yeah, it's a good question, and my opinion has kind of shifted a little bit over time as well. I think it also depends the type of market environment that you're in. Like if a company was raising money between 2011 and late 2015, especially 2013, 2014, 2015, it didn't really matter who was behind the company. It could have been, preeminent mining financiers that normally have excellent access to capital. That was such a tough market that even the best companies did need to raise with a warrant. So I think in those really brutal bear markets, you can get that combination of good people with really good terms. I think in this market, like it's a pretty decent mining market right now. And it's been strong, for 18 months with exceptions. Obviously it's cheap relative to many other asset classes, but it's a relatively healthy market. So I think the higher quality teams are able to raise without including a warrant or only including a half warrant. So in this type of market environment, I'm a little bit less of a stickler for the specific terms, a little bit less of a warrant hound, so to speak, that I might have been during the true bear market, 6 or 7 years ago. So that's how I'm kind of thinking about things. But, it's important not to get distracted or enamored by a full warrant. You're looking at a placement, that's great. Put the placement to the side, put the terms to the side, and look at the company from a bottom-up perspective. Then once you've kind of made that evaluation, you're thinking, is this something that I would buy on the open market, assuming that they were cashed up and didn't have to raise right now? The answer to that is yes. Then you can look at the placement terms. If you get a half or full warrant, then that could be very much a reason to participate. But it's a fine line between appreciating the power of a full warrant and becoming too enamored with it and going into lower quality deals, especially when there's money to be raised without having to go to those extremes.
Right. Excellent, Matt. Well, I think that's a good place to kind of wrap up today's discussion there. We sure covered a lot. Is there anything else you'd like to add before we do?
Well, we've covered a lot of ground, Tom, and I'm glad we were able to touch on the prospect generators. I bet it's been a while since that topic's come up on your show, because as I mentioned, they're quite out of favor. If any of the listeners want to learn more about the fund or see the recent investor letter, that's accessible on the fund's website at mjgcapital.com, and happy to chat with anybody about the fund or our investments. I appreciate you having me on.
Absolutely, Matt. It's always a pleasure to speak with you. And as well, you're available on Twitter at Geiger Counting. Matt, thanks so much for your time today.
That's right. Thanks, Tom. Appreciate it. We'll do this again soon.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.